Hi, I'm Urmi, editor here at Move Smartly, and I'm excited to introduce today's show. With so many financial headlines dominating the news, I'm talking to the perfect person to help us make sense of all the data. Rob McLister is an interest rate analyst, mortgage planner, and contributing writer for the Globe and Mail. A former equities trader and finance graduate at the University of Michigan, Rob dissects mortgage rates and writes about a range of issues impacting mortgage consumers. He is the author of the Mortgage Logic News, a subscription service bulletin that offers in-depth market analysis, and he's a great follow on Twitter at Rob McLister. You can find links to both of these in our show notes. And if you find our show useful, please hit the subscribe button and share this show with other viewers. It's very much appreciated. And now for the show. I want to start right off the bat with a tweet you sent out this morning talking about a pretty substantial change in thinking right now on rate cuts in Canada. Markets are now pricing in a dramatic turn in monetary policy, essentially a 50-50 chance of a rate cut at the Bank of Canada's next April 12th rate announcement. 4 cuts total through year end. That is, and there's is that your child self, Rob, in that little GIF?
No, that's a little Tiff Macklem, actually.
So let's unpack this for our viewers. Let's first of all talk about why, whether you think the markets are correct in what they're thinking and why they would be thinking that.
Well, not long ago, just a matter of weeks, we were talking about rate hikes. Okay, we were talking about no cuts whatsoever until next year. Now, all of a sudden, the little banking stress that we have here south of the border and in Europe is amounting to something. So think investors. And so investors are scared. When they get scared, they buy bonds. When there's buying pressure in bonds, then yields go down because the two things move inversely. So we're seeing now a significant turnaround in sentiment in the rate market, and that's going to filter through to Canada's mortgage rate market as well.
Right. So the fixed rates are based on those yields. And so originally when rates started to move down in the bond market, we didn't immediately see that filter through to borrowers. But I understand now, I think you also wrote about the fact that fixed rate mortgage borrowers are starting to see some lower rates.
Yeah, we saw in the last week or so, the lowest 5-year fixed rate, for example, dropped 35 basis points for an uninsured mortgage versus the prior week. So, some institutions are starting to pass through funding cost savings to borrowers, which is great. The banks, the big 6 banks who control, 80 to 90% of the funding, the mortgage funding in this country, they can take a little longer. Right? They have oligopoly power. They can take a little longer to cut rates. They're also worried, and they have legitimate reasons for kind of holding off here a bit. We're seeing with the banking stress south of the border, we're seeing credit spreads, which is basically the extra that investors demand banks pay to borrow money. We're seeing those spreads widen. So that increases the cost of funds to banks. We're seeing a lot of volatility, obviously, in the bond market. That increases banks' hedging costs. And banks don't want to, cut today and then have to raise tomorrow. So they kind of want to make sure that the trend is solidified before they make moves. So the big banks, if this trend continues, the big banks will be cutting fixed rates. And they'll wait, though, a little bit until they see how things kind of settle out.
Interesting. So quick to raise rates, but a little bit slower for them to come down. I've heard it. I've heard that talked about. Yes. That's right. Now, let's go back, Rob, and unpack a little bit about what exactly is going on in the markets. So the banking crisis that we saw with Silicon Valley Bank and some other banks as well, Credit Suisse, that's the banking concern that we're talking about. Now, originally, interest rates were going up because governments are fighting inflation, our inflationary economy. If the rates, and now people are thinking the rates will come down. Well, normally the rates would be coming down if that fight was successful. But now we have this other banking crisis on the side. So is it the case that it might not even be that the inflation battle is over? I don't think we've seen it's starting to come down, but we still see quite a bit of inflation, I think, on both sides of the border. So how do you factor in that there's these two kind of issues now playing into the same rate decisions?
Right. Well, making sure that the banking system's stable and liquid is job number one. And because if you don't get that job right, you're going to lead to significant disinflation, maybe deflation, and bad things can happen economically. So for now, that's taking precedence over the inflation fight. And so the other thing you have to think about is that we've increased, or central banks have increased rates significantly. One of the fastest rate hike cycles ever. And so, at least in modern times. And so it takes a little time for businesses and consumers to feel that. And, if you look at bank defaults, bank arrears, the percentage of people not paying their mortgage on time, we're still near record lows. There has not been enough pain in the system until recently. And so now that people are starting to feel the full brunt of these borrowing cost increases, it's going to have an effect on inflation. And inflation is already trending down. It's not coming down as fast as a lot of people would want, but it is going in the right direction. So, you have most economists thinking that inflation is going to be in the threes, have a 3 handle by the summer. And that's a very reasonable expectation by the end of summer. And so, the central banks are looking at all this and they're thinking that we better stabilize the banking system and kind of get back to inflation after that has worked itself out. And they don't know how deep the banking problems are going to be. They think they got a handle on things. They've slowed contagion for sure, but it's too early to say that they've stopped it.
Okay, that was going to be my next question, whether you think the moves so far, banks have, taken over, I guess, the other banks and governments have stepped in. Do you think that's enough, or is there still a lot that we haven't unpacked? I think I'm reading that the low interest rate environment that we've come out of for so long allowed so many of these, let's say, interesting, we'll use that euphemism, practices and sort of lending schemes and other things to flourish. And now is it time when the tide's starting to recede? There isn't as much financial liquidity in the market. Are there more risks of more banks sort of being exposed?
There's definitely more risk. And so that's why you have the market pricing in 100 basis points of rate cuts this year by both the Bank of Canada and the Fed. The markets don't do that for no reason. We're talking billions and billions of dollars every day, every hour being bet on direction of rates. And so these are, real traders, very informed traders, looking at the data, looking at the trends, the information and the risk, and making logical decisions about where they think rates are going. And they're really the best source that we can lean on to try and get a sense for where this is all going. And so, you think the Fed and the Bank of Canada would have the best data, and they generally do. But they're really no match long term for the market. The market takes all the information from all sources with practically unlimited dollars to bet in one direction or the other. So when you see big moves like this, we see 7 sigma moves in the 2-year yield, for example. And the 2-year yield is a government bond yield that kind of foreshadows where interest rates are going. So like a 7 standard deviation move in that security, which is normally pretty liquid, is significant. It's telling you there's a lot of fear out there, and that it's legitimate fear. And I think that it's going to pan out. You don't see these massive bets for no reason. So the odds are that whether we get rate cuts next month, a couple months, 6 months from now, we're going to get them. That's the bottom line.
So this is interesting. So is your sense that those rate cuts are being priced in by the market solely because of the banking issue? It's not, or are there, because another reason why, for example, we might start to see that is if the measures have cool down the economy, pushing it into the economies into recession. So are those rate cuts around this banking fear, or are there also concerns that there could be a recession in the horizon as well?
Both. So at the time, you never really know whether you've over tightened. But generally speaking, central banks over tighten. They go too far. And, we'll 3 months from now, maybe 6 months from now, we'll know whether, rates have peaked and they did in fact go too far. But, they have a job to do. They're doing the best they can. They're very data dependent. They're looking at all the numbers coming in. And, to start this year, the economy is going gangbusters for, considering the fact that rates are up over 400 basis points. So, I think that right now it's totally risk off. People don't know what's going to happen next. It's going to take, weeks, I think, for this banking mini crisis. I'm calling it a mini crisis. We don't know if it's a full blown crisis yet, but it's going to take, a matter of weeks to figure out how deep this swamp goes with banks. And the Fed right now, its job is to make sure that banks are liquid and that there's no failures, that runs are contained, that they can still continue operating, lending. And so I think that, the market's looking for a 50-50 chance of a Bank of Canada rate cut at its next meeting on April 12th. That's just a dramatic change in sentiment. And so it shows you how central banks are going to step back from the inflation fighting mission, at least temporarily, and see how this all plays out.
So can you also talk a little bit more about that then? The different trajectories that would put Canada and US central banks. The Americans just raised their rate 25 basis points. That was lower than expected. Some people thought 50, some people thought 100. It seems like this banking crisis did a little bit of the bankers' work for them. So as we were talking about, but if what you're saying about the market's predictions on April 12th for Canada is true, that would start to put them in different trajectories. Can that happen for very long?
Well, the Canadian and US central banks generally move together. Sometimes you can have a spread, 50 basis points or whatever it is, depending on the circumstances, but they generally move together since the economies are so tied. So if the Bank of Canada were to cut next meeting, theoretically, it's very likely that US cuts wouldn't be far off.
Okay, now let's talk a little bit more, maybe micro, in the Canadian mortgage lending environment. We are starting to see the first of some evidence that there are an uptick in forced sales or prior sales, or maybe even people trying to get ahead of the bank forcing them to sell. Now, my understanding from my reading is this is starting to hit mainly the private lending kind of sector of the mortgage market. People who have second, third mortgages, or in other words, they were having a hard time qualifying probably for their mortgages at the big banks. They've gone to private lenders. In this tightening lending environment, some lenders are just refusing to renew. So that means you have to either try to requalify at bigger banks and you can't at higher rates, or in other cases, they're asking them to meet interest rates they cannot. So I have heard that this is an issue, and obviously there's a lot of individual pain for households involved, but that it overall doesn't make a big part of the Canadian market. Is that something like your sense of it, or do you think this could be concentrated in certain areas, certain geographical areas, and lead to a spillover effect in certain areas of the market?
Systematically or systemically, there's no significant risk of power sales from private mortgages. It's going to make headlines, but I think I saw a story recently. There's 105 power sales in Ontario. Well, there's 3.8 million homeowner households in Ontario, so we're talking like 0.00003 of the households that are in power of sale, according to the latest numbers. The fact is that, this is a drop in the bucket. It's not anything I'm remotely worried about at this point. We're at 15 basis points arrears in the latest numbers from December. Those are lagging numbers, but the current real-time numbers I get from lenders, anecdotally when I talk to them, we're not much off those levels. In fact, 30-day arrears at First National, one of the biggest lenders in Canada, were actually down quarter on quarter. So lenders are managing risk extremely well. The last thing that regulators want is to see an arrears problem in Canada. And so banks have full latitude to do what they need to do to help borrowers keep current. There's going to be an uptick in defaults, no question. I don't know how big it's going to be. I don't think it's going to be big. It's certainly going to be nowhere near the 100 plus basis points we saw in the early 80s. Banks will, manage that process well. I think that as long as home values don't go further in the toilet, people will be able to sell and pay off their lender and hopefully pay off their realtor, and they'll be able to get out of bad situations. It's when you have all these negative things happening and home values are going down. So right now, in most markets I'm seeing, there's it's a pretty buoyant real estate market out there, all things considered. Sales aren't off the hook, but you also have pretty tight listings. And so as long as you don't see significant new lows in home values nationwide, then the mortgage market's going to be in good shape.
Right. So you don't think those low levels of listings, what we're seeing, which is actually matching the very low levels of sales there, because together they're holding prices down. You don't see forced sales and things like that causing a change in that listing level to any notable degree.
Correct.
Yeah. And I had another question about the regulation side of this. Do you think what's happening here will lead the OSFI and other regulators to look at some of these private lenders or the practices that maybe, again, a sudden increase rate rise environment reveals some of these, these lenders being a little bit shakier than others? Do you think there could be any changes to the mortgage industry, how mortgages are issued, either in the private space or other places? Some people even talk about, sharing data between the CRA and mortgage entities, lenders, so that you can verify a borrower's income more reliably, rather than, depending on what people are just saying and things that can be, fraudulently provided in terms of documentation. So I'm wondering if you think this little scare will change anything, or do you think we'll probably just start humming again and the chance for any changes might go?
Well, if we're talking private lending, OSFI doesn't really have jurisdiction over private lenders. So, will the provincial authorities and do much about it? I don't think so. We've had downturns before. We've had pressure in the private lending space before. It's just not systemically a big enough problem. So I don't, this whole private lending concern or with mix or whatnot, I don't think it's going to amount to much.
Right. Okay. So I know your time.
Let me just clarify that.
Yeah,
one.
sure.
So with respect to an actual borrower, if you're a borrower who desperately needs liquidity and you can't find it from a private lender that might have lent you money, a year ago, now you don't have any options, and your home is, maybe underwater, or there's not enough equity in it to pay everything out, then you got a problem. So, I don't mean to make light on this from an individual borrower standpoint, but from a system-wide standpoint, not a concern.
Yeah. And we're seeing some really, heartbreaking stories. It's always easy to judge when people get themselves into these situations, but I do think we forget how much that lure of wanting to provide a home for your family can get people into situations that can be quite tricky and quite sad. So it's awful. But as you're saying, overall, do we see this as having a larger impact? You're saying not very likely, and that sort of adds up to what I'm reading as well. Now, the only thing I think Canadians are very well known for hanging in there, cutting every cost possible, keeping up with their mortgage payments. The only thing that gets in the way of that is job losses. normally when it comes to housing, like you were talking about, the house prices already coming into being in the toilet, which they quite right now they're holding. There's been a decline since peaks that were realized, very high peaks in increases over the pandemic period. They've declined since those peaks, but they're holding because of what we've said about the sales and the listing volumes. What do you think about the rest of the year? Is there a chance of a wider economic downturn resulting in job losses? And could that affect the Canadian housing market? What is your sense of how big a risk that is right now?
Yeah, well, I think you have to look at the best indicators we have. So one of the best is the yield curve. When you see a 10-year minus 2-year bond at minus 100 basis points, multi-decade negative yields in that spread, that tells you something. That tells you that there's a very high probability of recession. It's been a pretty reliable indicator over the years. Leading economic indicators, also reliable. Again, all pointing towards recession. And so high probability we get recession. As I've written before, the housing market holds up pretty well during recession, especially in this day and age, where you have, household formation. We have 500,000 person immigrant targets. All these folks need a roof. And you don't have a lot of listings. And now you have rates potentially going down on demand. From a demand perspective, interest rates are rocket fuel for home prices. And so if we see, that the lowest 5-year fix, for example, which is at 4.79 today, drop to, even 100 basis points, you're going to notice a nice boost, I think, in the housing market, barring some catastrophe we can't foresee at this point. So if you're playing the odds, I think that you look at kind of where we are in the rate cycle, you look at what housing's done in the past when our central banks are cutting rates, you look at the fundamentals, you look at rising incomes, you look at everything, and you have to assume that housing is at least stable, if not potentially nearing another bull run. And so I think that once you see rate cuts become imminent, once the market start pricing in a full cut by the Bank of Canada in the next meeting or so, I think that you'll see people realize, hey, listen, man, we could be going back towards the highs on home values, and I better get in. I don't know if that's going to happen, this spring. But if you see the 5-year yield dip back below 2%, which is a distinct possibility, if we get a recession, then 5-year fixed rates could be back in the threes by year end. And hey, I think that can only be positive for housing, other things equal.
Interesting. Okay. So the sense that we have that the job situation, the income, it's not as tied as it used to be. There seems to be now more capital in Canadian housing in general. As you said, immigrants coming, maybe households sharing their wealth. So taking money out of some of the capital they already have a lot of equity, some of the properties they have equity in, and sharing that with other parts of family. So the sense is that there's maybe a looser link than we would have seen in the 80s, for example.
Yeah, like right now, unemployment near long-term lows, that's normal heading into a recession. And so we have to expect at least, a 2 percentage point increase in unemployment. I don't think that's going to be enough to significantly derail housing, or at least derail it for long. And so, there's just too many other fundamentals at play, especially in markets that are high demand. Your job's in, downtown Toronto. How far are you willing to live from downtown Toronto, assuming that you're not lucky enough to work from home? Like, it's just, the immigration centers where, folks are moving to, by and large, it's only a small number of markets in Canada, and there's just all these pressures in those areas. And what did you see? 60,000 people move out of Ontario recently. Well, that was offset by well over 200,000 people coming in. So, just the fundamentals have not significantly deteriorated. You're going to see defaults go up. You're going to see unemployment go up. You're going to see some ugly headlines maybe. But I think that, if you look back 2 years from now, that it's going to prove to be probably most likely a buying opportunity around these levels. Whether prices go down another 5%, 10%, who knows? But if you're an investor, if you're someone with a long-term time horizon, you can take risk, you're well qualified as a borrower, then, I would not be overly scared to buy a home in Canada right now.
Wow. So seems like the unaffordability of Canadian housing is probably going to be a story once again.
Yeah, and another story is going to be the OSFI changes, which are going to add, a headwind. It's too early to quantify what that headwind could be. But again, I don't think the OSFI wants to do anything to significantly deteriorate the value of bank security. Banks would be in a much worse situation if, the median home price in Canada fell 35% instead of 20%. So I don't think that OSFI is going to do anything too dire. I think we might be surprised at some of the things that it's going to do in the next year or so. But I don't think that they're going to push the housing market off a cliff.
Right. So the federal regulator of banks has a very strong interest in seeing those banks weather the storm safely. Now, the changes, just briefly, I know you don't have a lot of time, are being contemplated. Is this around looking at the overall debt levels that people hold? Because other kinds of measures, like right now, a lot of people are getting mortgages, for example, and they're evaluated per mortgage on what their debt levels are. One perspective change might be to look at their total outstanding debt. Are those the type of changes you're talking about?
Yes. And so the big headline one, there's multiple proposals that OSFI's made, but the big headline one is this loan to income ratio. And so, they're proposing the potential of setting a limit. So that limit being that you cannot buy a home that's and mortgage it for more than 450% of your gross household income. And that type of thing has been adopted in other countries, and it has, slowed the market for a period of time, and it will slow our market for a period of time potentially. But I don't think it's going to have a big enough impact if OSFI does what it proposes, and that is to only hold banks to limiting that amount, or allowing banks to extend an exception to that rule for up to about 25%, maybe 30% of bank borrowers. So there's just not that drastic a number of people that would prevent from buying a home. And so there's also other options for those folks, whether it's a credit union or someone that's non-federally regulated to get into the housing market. So it's going to have an effect. It'll be headwind, but I don't think it's going to be drastic.
All right. Some maybe calmer interpretation of some of the crazy headlines we're seeing. Thanks so much, Rob. Lots changing, so we'd love to have you back on in a couple of months to see what where we're at by then.
It's a pleasure, Urmi. And keep an eye on those variable rates. I think that we might see a rotation back into variable, which could be interesting as well.
Yeah, absolutely. Let's talk about that next time. Thanks so much, Rob.